great way to pay yourself. It's a great way to have a savings account because it comes out before you even see it. You can do that at your jobs. Automatic savings. Your 401k. Some of us wouldn't have retirement accounts if it wasn't for 401ks coming out, and that's okay. But you should take advantage of that. A 401k, a retirement savings plan. They take it out before you even see it. You don't miss it because it's already out. You end up with retirement savings. You can also do that with savings account. It might be $5 a check, $10 a check, $50 a check, or whatever. It's a good way, automatic savings, to set up a savings account. A lot of people, what they do is they spend everything, so if the unexpected happens, they have to borrow. And how many people know the unexpected is really expected? Your car is going to break down, an appliance is going to break down, you're going to need to take a trip, somebody's going to die. So even though it's unexpected, it's going to happen. A lot of people don't plan for it, so when it comes up, they have to use their credit card, they have to borrow from somebody. And the thing is if you're proactive and start saving today, those unexpected things won't hit you so hard. They won't hit you so hard. So when the car breaks down, and if you have $1,000 set aside, you have a $500 bill, you don't have to worry about charging it or borrowing it from somebody. So it's so important. Savings is an important part, a very, very important part of a budget. Very important. Now let's look at banking. Banks and credit unions, another financial institution, they offer a variety of products, but we're going to just look at checking and savings accounts tonight because they're the main ones we use. Checking accounts, looking at checking accounts, they allow access to your money at any time, especially with an ATM card or a check card, anytime. They may or may not pay interest. Some of them do, some of them don't. They enable you to write checks telling your bank to give the money to whoever you wrote that check to. So if I write you a check for $100 with your name on it, you present it at my bank, they'll give you that money because that's my relationship with the bank if there's money in my account. And also, they enable you to use your check card or your debit card to make purchases. So the money in your account comes out of your checking account. And I think it's a good place to keep money for everyday expenses. Some people keep money under their mattress, in their drawer, in that little jar. But personally, I think banks are a good place to keep your money for those everyday expenses. Then we look at savings accounts. They also allow access to your money at any time. They pay interest. So if you have money, banks pay you interest to keep your money in their bank. Usually when it's not great amounts of money, the interest isn't that great. Nevertheless, savings accounts pay interest. They enable you to transfer money from different accounts. So let's say you've got $10,000. You wouldn't keep it in your checking account because your checking account is where you pay your bills. You keep it in your savings account, get interest, but then when you need to pay bills, you would transfer it to your checking account so you could get the interest in your savings account. And again, it's a good place to set aside money for the future or for savings. Along with banking come NSFs and overdrafts. Anybody know what an overdraft is? Just one person? Just two? Just three? Okay, thank you. I thought I was in the wrong place. Okay. When you write a check or use your check card and you don't have enough money in your bank account to cover that, you have non-sufficient funds or you create an overdraft. Banks charge you, right now it's between $25 and $38 every time that happens. That can become very, very, very expensive. This is how expensive it can become. Look at this. You can go to McDonald's. Let's say you have $2 in your account. I'm sure you don't need this math because some of you know how this works. You have $2 in your account. You decide to go to McDonald's. You get a $5 meal. That's one overdraft, $38. You decide after you go to McDonald's, you want to go to a movie. $7.50. That's another $38. So for $12.50, $11.50, we've got $76 in overdraft fees. And then after that, you decide, after you go to the movie, you decide that you want to go somewhere else and spend $5 more. That's $38 more. And that's how it happens. It might sound ridiculous, that's how it happens. People can be overdrawn $15, have 3 fees, and pay over $100. They write themselves a short-term loan for $38. And like I said, it can become very expensive. It's not really worth it to spend that $15 and pay the bank that $100. And I know it well, like Preston said, in financial services for a long time. I worked at a bank where our budget, it was just a small bank, our budget was about $500,000 for that year in overdraft charges. Because we knew people would do it. We knew people would do it. And you know what? They didn't disappoint us. They didn't disappoint us. Because they felt it was okay to write themselves a high-paying loan, very high-paying loan. But the thing is you're giving your money away. You're giving your money away. And you can keep that money in your pocket if you make a budget, just plan a little bit, and maybe not spend it on things that you don't need. Now, your financial institution, they can either pay the overdraft or they can return it. These days, they pay it more. And the reason they pay it more, you know why? They want to encourage you to keep overdrawing your account. They want to encourage you, keep overdrawing that account because they like the money. They like the money. Because then they can pay bonuses and things like that. They like the money. But the thing is, you should be very careful about that. But if they do return it, not only will you pay your bank, but you'll pay the merchant that you wrote that check to. Because everybody's got to pay for the fact that they thought that was going to go through. Well, the merchant has to pay the bank for you returning your check. It used to be to prevent you for overdrawing your check. It used to be. But now it's to encourage. It's really encouraged now. But again, you're throwing away your money. You don't want to do that. You do not want to do that. Dr. King said, we must accept finite disappointment, but never lose infinite hope. We've made some mistakes in the past. We can be disappointed about it, but we shouldn't lose hope because we can make a change. We can make a change. We do have hope that things can change. So yeah, we can be disappointed about what happened in the past, but know that there's hope. There is hope. We might take little steps and it might take a while, but believe me, things can and they will change. Let's look at using credit. When we look at using credit, loan essentials are, if you need money to pay for a house, unless you can pull it out of your pocket, like Preston and Lasagna, and just pay like $200,000 for a house, you might have to get a loan. You might have to get a loan to pay for these things. Or college education or a car, you'd have to get the loan for it. What happens is the lender provides you with the principal to pay for this, and you promise to pay the principal along with interest. Interest rates, very, very important. When we look at interest rates, we've got fixed rates and variable rates. Fixed rates, they stay the same for the whole term of the loan. You might have a 5-year loan. If it's a mortgage, a 30-year loan, the interest rate's not going to change. You have a variable or adjustable rate. And we've heard a lot about adjustable rates, especially with the foreclosure, the mortgage crisis. A lot of people had loans that they started at one rate, and then 2 years later, they raised to maybe 2 percentage points higher. So we have variable and adjustable rates. And it's so important for you to know your interest rate. And I say that because when I think about car salesmen, one thing, you go into a car dealer, one of the first things they ask you is how much do you want to pay? They don't ask you what interest rate you want to pay. They ask you how much, because what they can do is they can fit you in a payment, whereas you might have been paying 5%, but because you just wanted a certain payment, you might be paying 11%. And the more interest you pay, the more you're paying for that loan. The interest is the cost you pay for that loan. So you should know the interest rate you're paying. Somebody came to me and they found out what I did, and they said, I don't want to get in foreclosure. I want you to help me. And the first thing I'm thinking, maybe they need to refinance. And I said, well, what interest rate are you paying? And he said he didn't know. And I'm thinking, how don't you know? And I know why people don't know, because they think about getting into the house. They think about the payment. But I think you should know what interest rate you're paying, because how would you know what a better interest rate is if you don't know what rate you're paying? You need to know what interest rate you're paying. Security. When I talk about security, there's secured loans and unsecured loans. Secured loans are loans that are secured with collateral. Collateral can be a house, if it's a mortgage, a car, or it could be cash. You know, sometimes there's savings accounts. You could lend money against your savings account. And the thing is those are some of the most inexpensive loans you can get, because the